All right, everybody, welcome back to Cover Call ETF Investing. If you are new to the channel, special welcome to you. Today, I have on the channel Mike Clare, Senior Portfolio Manager over at Brompton Funds, and today we want to just address some of the more general questions about Cover Call ETFs, income strategies. What are sort of the curiosities out there for those who are certainly more seasoned, but also for those who are just coming into this space who maybe have seen my content or maybe some other financial influencers content as well. So, welcome to the channel, Mike.
Yeah, thank you for having me.
And do you maybe before we start, do you want to maybe just describe a little bit about your role over at Brompton Funds?
Yeah, so I'm a senior portfolio manager at Brompton Funds. We have a smallish team. Our investment team is 6 people, so I'm one of the senior members of the team, and we do, a bunch of different ETFs and funds for investors, and we're pretty active in the covered call space. So I spend a lot of my day, thinking about our portfolios, the types of investments we're making, researching stocks, thinking about portfolio strategy, and then of course, thinking about and executing on our covered call program on top of that as well.
Perfect. So let's dive into the first question. Why should an investor care about volatility if said investor is investing for regular, stable income distributions? And we see plenty of funds across Canada that have very stable distributions. So why should they care about volatility at all?
Yeah, so we think about volatility, especially when it comes to, a covered call strategy. We think about volatility as, something that has potential value for your portfolio. And so when we look at options, and of course with covered calls, we're selling options on our portfolio holdings. One of the key, there's a number of different factors that drive the price of an option or the premium that you receive when you sell an option, but the key market factor that drives prices is volatility. And so, of course, if volatility is higher, if the market thinks that, stocks or the market are going to move around quite a bit, then that will, of course, result in higher premiums. If you think about it, like a simple example, like volatile stocks like Nvidia or Tesla tend to move around quite a bit, and so those will tend to have higher options premiums just because there's a higher likelihood that those will end up in the money from the perspective of the option buyer. And so we view, volatility as something of value when we're selling options on our portfolio, writing covered calls. We view that to some extent as, selling that volatility in exchange for a regular cash flow in terms of the premiums we bring in for the portfolio. So one way to think about it is we're taking that volatility and converting it to an income stream.
I see. So if someone is getting into an income strategy, they might not be as aware. Like basically, what I'm trying to get at is, if you're an income investor, should you really fear volatility if you're essentially getting a portion of your return from that volatility?
Yeah, I think it depends. Obviously, for each investor, may have an individual sort of risk tolerance. I think to some extent it depends on your risk tolerance. Like if you're retired and you rely on cash flow for your lifestyle, then maybe you want to go the less risky route, which would be more of like a bond portfolio. But if you do have if you're younger and you're looking for some aspect of income in your portfolio as well as potential capital returns, then covered calls are a great way to approach that, I think.
Yeah, for sure. I think no, I think that's well said there. Yeah, I think if I think that's certainly I think a transition that comes with a little bit more time, with the more experience that a retail investor might get with an income strategy is that transition from you just like realizing that that portion of your return is coming from the volatility and the premiums generated from that volatility, like you had mentioned.
Right. And it's also, another thing, it's also a way to, invest in stocks or sectors or strategies where there's not traditionally a lot of income, like technology, for example, which we think is a great place to be invested. A lot of tech stocks either don't have a dividend, don't pay a dividend, or it's a small dividend. And so you can invest in companies like Nvidia and then use the volatility to to generate some income on that portfolio. Whereas if you were just going the traditional route of investing for dividends, you would maybe be stuck, not buying those stocks.
Yeah, for sure. You might be a little bit more, you might maybe tailor more of that portfolio potentially if you want that yield to more sort of the old guard kinds of sectors like energy and financials and maybe some utilities in there as well that generate those higher dividends, especially we see here in Canada.
Right.
Yeah. So for the next question, are volatile conditions the best for covered call ETFs? If not, what would be the ideal environment for a general range of income investors?
Yeah, so it's a really good question. And the short answer, like a lot of things, is it depends.
Mm, of course.
Now we have done, we've been doing covered call strategies for a number of years. We've obviously done a lot of research in the space, and there's been, research put out there publicly that looks at how covered call strategies and option selling strategies sell in different types of market environments. And to summarize that research, ultimately, like we think the best type of environment for covered calls is a moderate volatility environment. So like Goldilocks, not too high, not too low. And so
Mm,
when we break down the different market regimes, we look at market volatility, whether it's a high return, moderate volatility environment or a low return, moderate volatility environment. Covered call strategies tend to have pretty good risk adjusted returns in those environments. Another market regime, of course, is a market characterized by extreme stress. So something, think about like the financial crisis back in 2008, 2009. Of course, most equity portfolios would not perform well in that type of environment, but because a covered call strategy is bringing in a regular income source, taking that volatility of the portfolio and converting it into something known in terms of the income, we do see covered call strategies tend to outperform in extreme stress environments. Although, of course, you're not going to see positive performance in that environment. It's just outperforming relative to the same strategy without covered calls.
yeah.
But there are some caveats to that, of course. Like the flip side of bringing in premium income from selling calls is you are giving up some of that upside. So when we do see big bounces off the bottom, like we saw, for example, in COVID in March 2020, the market sold off quite aggressively over the period of 4 weeks, and then of course bounced quite aggressively. And so if you had a passive covered call strategy at that time, potentially gave up too much upside on the way back. And so we got to think about those types of things. That's why I say it depends. The one environment where I think covered calls tend to not do as well would be what we call a low volatility bull market. Not
Mm,
something we're in currently, but think about a year like 2017 where the market just sort of grinded higher slowly. There were very few pullbacks during that year. I think most of the pullbacks were in the 3 to 5% range. Volatility was quite low, and so what that means is you're not bringing in as much premium income for the portfolio. You're capping some of that upside, and so you tend to see covered call strategies outperform in that environment. But of course, with positive performance because the market's doing well.
right. I see. I see. Yeah, that you know what? I never really I can't say I really thought about that before that maybe an environment on the positive end where they don't necessarily do as great, like you said, volatility is a little bit lower. Who knows? Maybe it's in the 10 to 12 range with the VIX, just hypothetically. And like you said, kind of grinding a bit higher and higher, not much as far as pullbacks are
Yeah.
concerned on that end of things.
One other point I want to make there too is ultimately it does depend on the price at which we're selling these options. It does depend on our ability to execute on the strategy.
Mhm.
Um, and just to illustrate this point, like one way we like to look at options, or selling options, covered calls, is kind of like an insurance company, right? Like an insurance company brings in premiums from customers paying for auto insurance or home insurance or whatever, but then they have payments out depending on an uncertain future event. You get your car stolen, get in an accident, fire in your house, something like that. Covered calls, they kind of work the same way, right? You bring in this income stream. If markets are sideways or they go down, you get to keep that premium. But if markets go up, there's there's negative value to that because you're capping the upside on your portfolio. You've got to deliver, if a stock goes, you write an option at $100 and the stock goes to 110,
Mhm.
you've got the obligation to deliver that stock at 100, right? So it does depend on price. So if you're, again, back to the insurance company example, if an insurance company underpriced their premiums, they wouldn't make money over time,
No.
right? So we've got to think about that. You've got to think about the ability to execute. Option markets tend to be illiquid, and so I think having a sort of an institutional manager that has the experience in that is important.
Yeah. Perfect. For our next question, can you explain the relationship between portfolio and coverage and moneyness? Probably one of the most important questions for a income investor to understand. And what I'll try and do here, I'll just pull up just a graphic that we can maybe share with the audience here.
Oh, sure, yeah. This is a slide we've had from a past webinar.
Okay.
Because I wanted to make the point here is that, we talk about covered call strategies broadly, but there really are quite a few differences among different managers that manage these covered call strategies. And as you mentioned, right, the two key ways we can influence our strategy is either to write more options, have like a increased coverage on the portfolio. Do you want to write on 25% of the portfolio, 50%, 100% of the portfolio? And then the other lever we can pull, of course, is moneyness, right? So it's, do you write at the money calls, which brings in higher premiums? Do you write something more like 3 to 5% out of the money, which may bring in fewer premiums, but gives you more exposure to the upside on the portfolio? And then do you want to do that on a passive basis or an active basis? Of course, on a passive basis, meaning, there are some strategies out there where the manager is just writing options on a fixed percentage of the portfolio monthly, no matter what the market conditions are. And then, of course, there's an active approach as well, where we will consider the market environment. Like we talked about, maybe covered calls don't work as well in a low volatility bull market. So maybe we want to write on smaller percentage of the portfolio in that type of environment. Maybe when volatility is a little bit higher, we can write a little bit farther out of the money, still bring in pretty good premiums, but also participate in upside when the market does bounce.
I- Okay. Would you say that we saw in my opinion, and correct me if I'm wrong on this, but maybe between the years of 2010 and 2020, that seemed to be that's where these passive ETFs really exploded. It was seemed to be a predictable upmarket, no real big shocks like we saw during the Great Recession. And obviously, you're right, like that period of time is wedged between COVID, Great Recession. And now we're post-COVID, and it seems like active management seems to be having more of a resurgence of sorts. Would you say that like passive ETFs, albeit they're still massive, lots of AUM across multiple fund managers, but would you say that maybe in this period of time right now, maybe this decade, who knows, but with more geopolitical stuff going on and interest rates and inflation and unemployment and yeah, the geopolitics, like is this more of an environment that investors should consider to have a more active management in their portfolios is basically what I'm trying to get at.
Yes, I would agree with that, and that would be both with respect to just your underlying investments as well as a covered call strategy.
Hmm.
It was, as you said, when things ran up post financial crisis, really through to COVID, the market really did grind higher with not a lot of volatility. There was a lot of flow of funds into passive strategies, and that helped push the market higher. But I do agree with you. I do think we're in a much different environment in this decade, especially in the post COVID era. We've seen higher inflation, higher interest rates. I don't think we're going back to zero rates anytime soon.
Yeah, probably not.
Markets have been much more volatile, and that volatility always changes too, right? You see periods of increased volatility, periods of lower volatility. And so from a covered call strategy perspective, I think it makes sense to look at strategies or managers where you can take that into consideration and sort of adjust the different levers on the portfolio to take advantage of changes in the environment.
Yeah, no, that's perfect. Because I mean, if you're going for an active strategy, or if that's more of, for the investors that watch my channel, having a more active and tactical approach and be able to swivel on a dime, whatever the market, like these days, the market moves for an X post. Right? Like we see that it seems like on a more regular basis, you'll see something on social media, some very big figure will say something that's maybe a bit controversial, and the market moves to that, and you guys got to adapt as well very quickly to whatever kind of announcements are made, I would imagine.
Of course, yeah.
Yeah. Yeah, would you say it's better to have a lower or higher portfolio coverage on a fund during more turbulence in the market?
So I think again, I'll come back to my answer of it depends.
Mm,
Um, so it's when you have more turbulence, it's not necessarily better or worse to write more calls. Like generally, like higher volatility, of course, results in higher premiums. But that also gives us flexibility to either reduce the coverage of the portfolio and still bring in the same premium income, or as I mentioned, write farther out of the money and still bring in the same premium income. So it does. It's not necessarily better or worse. As I mentioned, we think sort of moderate volatility environments tend to be good environments for covered call strategies, but it can also depend on our expectation for whether the markets will rise or fall in the near term. Of course, if markets are falling or are going sideways, covered calls work great. If you get those big bounces in the market off the bottom, then you can potentially cap too much upside.
I see. And, if for the members of the audience that are maybe familiar with the VIX, is
Mhm.
there maybe a VIX range that maybe you could even speak to the industry at large who focus on income related products? Is there a VIX range that the industry really likes on average?
Yeah, I mean, I can't speak for the industry necessarily as a whole, but we tend to like, when the VIX is below 15, that's more of an indication that you're in this sort of potentially low volatility bull market type of environment. When the VIX is above 15, that tends to be a better environment for writing calls. Now, sometimes when the VIX gets too high, like when you see spikes, like we did in early April this year when it spiked to over 50, that's not necessarily a great time to write calls because again, you're risking a big bounce in the market when that volatility comes down and potentially giving up some of the upside there.
I see. Right. And what kind of moneyness would work well in tandem for a broad range of income investors when we're talking about, yeah, I mean, we talked about portfolio coverage, talking about moneyness. What's sort of that sort of nice range, whether it's in the money, at the money, out of the money?
Yeah, so generally we think that, you know, at the money calls, oftentimes investors are giving up too much upside
Hmm.
because we can't forget about the fact that, you're bringing in premium income, as I mentioned, but you're also uh, selling volatility, capping that upside. So the closer you right to the money, the more premiums you bring in, you're actually reducing your portfolio, your exposure to the portfolio. So our research actually shows that, as a broad rule of thumb, calls in the 3 to 5% out of the money range tend to work really well. It's a good blend of premium income plus some upside participation.
Hmm.
But it's just a rule of thumb. It could be lower for lower volatility portfolios. Like say you have a utilities portfolio where the stocks don't move around too much. You could have a lower range, or if you had a technology portfolio, it could be something more like 5 to 10% out of the money that works.
Yeah. And just for the audience here, Uh, when maybe I'm asking questions that are again trying to relate to a specific range, a specific number that maybe for a broad range of income investors. Just remember for everybody watching, this could be a starting point for you. Of course, everybody has their own goals, their own comfort levels, their own interests in how they invest. Maybe they're a hybrid investor with income. But at least some of these ranges could be a starting point. It's just something just to think about when getting into some of these strategies. And also to your point, albeit this isn't specific research I've done, it's just more anecdotal evidence. But I would tend to agree, as someone who's been investing in covered calls for the past 3 years. What I see is a hunger for still being able to maintain growth and still maintain and still get some attractive income for those who still want their portfolios to at least try to grow naturally and potentially a yield that's nothing too crazy, but for the sake of the general audience as a starting point, if you're newer, maybe around the 10 to 12% range. Is that something maybe you could speak to as well?
Is there in terms of the coverage of the portfolio or
Yeah,
or
just
the
in terms of like what you see from, say, income investors as far as, wanting growth and income as well. Is that yield attributed to those who want more, to still want growth? Would you say like what yield range
oh, what yield
is
rate? Yeah.
yeah,
Again, like that, it really does depend on the underlying strategy, right? And what like so we think about total or covered calls and a portfolio of stocks that has covered calls on top of it. Like we think about it in terms of like total return. And so this is where maybe I want to get into the difference between sources of return and then the distribution that that fund pays as well. Because of course, sources of return for a portfolio could be things like dividends on the stocks, could be option premiums, of course. But then it can also include like capital gains and losses, whether those are realized or unrealized,
I see.
including on the options portfolio as well, right?
Yeah,
The distribution that a fund pays to some extent is different than that. It's not it's not a source of return, it's a reflection of that return. And so I think when investors are looking at different covered call strategies, you want to try and assess whether the distribution that the fund is paying is sustainable in the long term based on everything else going on in the portfolio. So I can't really give you that's why I can't really give you a single number in terms of like 10 to 12%. It depends if you've got a say a bond portfolio, a portfolio of treasuries with covered calls on top of it. You may expect that the long run total return on that portfolio is more something like 5%.
yeah,
And so if the fund is trying to pay out a distribution of 10% or 12% or 15%, then there's a risk that the net asset value declines over time because you're overpaying the long run return. Versus if you have, say, like a technology portfolio where like the NASDAQ over the last, you know, 10 plus years has done like high teens annual return, you're participating in that exposure. You're earning some dividends on the portfolio. Stocks are performing well, really well. You're writing some options, generating some premiums. Like maybe something in the double digit range is achievable for those types of funds. So I think it really, sorry to keep saying it depends, but it really does depend on the strategy. And I think it's a good question. It's really important for I think investors to understand the difference between the return and the total return that a fund or strategy can generate over the long run and the distribution, and to make sure that those line up as best possible, or at least to make sure that the distribution of fund is paying, doesn't exceed that return potential in the long run. Of course, you get fluctuations in the market. It may exceed it in one year. You may have a negative return on the portfolio, but you can still pay a distribution. But then in the next year, you have like a big return, say like 20, 25%, and you're only paying 10. So you make it up that way.
I see. Yeah, you know what? Perfect. Again, from the anecdotal side of things, it's the I, all I can say is right. It's naturally people gravitate towards those higher yields, of course, as you had mentioned, Mike, understanding how you're getting that return and depending on what the strategy includes and who's doing it, there's all kinds of layers that income investors definitely need to be aware of, so that these funds can provide for their necessities, their goals, whatever it might do for them. Now, the next question, I am really curious to get your opinion on this because this is something I know myself and many do wonder about. And it is in times of heightened volatility that we've experienced, especially since Liberation Day, with most Canadian covered call ETF fund managers opting for stable distributions. Is there an incentive to generate more income? If so, where does it go if it's just one locked in distribution every single month?
Yeah, right. So again, this gets back to a little bit about what we were just talking about, right? So if a fund is earning a return,
Hmm.
um, a component of that return is option premiums. A component of that return is how the option performance does, depending on moves in the market.
Yeah.
But ultimately, like if a fund is paying a distribution that's greater than the return, so say you have like a fund and the net asset value of the fund is $10 per unit. You earn a return of $1 a unit, but you pay out $2 a unit of dividends, then the net asset value is going to go down to $9 because you've overpaid,
Yeah.
right? So in terms of like where does that go? If a fund is paying a distribution that's greater than its return, it comes out of the NAV. If a
Right.
fund is earning a return that's above the distribution, then it gets added to the NAV, and that's what you're getting at in terms of having potentially a strategy that is a mix of income and growth, where you can earn or, get paid a pretty good distribution on a monthly basis, but also participate in some upside, and hopefully the value of your investment, or the net asset value of the fund will grow over time as well.
I see.
Make
Okay.
sense? Yeah.
Yeah, no, no, that's you know what? I think that's a fairly easy explanation for the audience to get with. Effectively speaking, right, as you had mentioned, if it's just stable and you earn more of a premium in a particular month, you're essentially just reinvesting that back into the fund,
Right.
and then the NAV grows from that point, which makes total sense. And then
Right.
when it goes and yeah, and I mean you effectively see that either way grinding the nav down or
Yeah.
was going up. So, yep, that's a great explanation there. What kinds of dangers might an income investor face when investing in strategies with yields that are 20% plus versus maybe the 10 to 20% range, or even in the single digit range, 5 to 9%? Let me guess, it depends.
Yeah, yeah, yeah. Now, it does depend, but when we're getting into funds that have a distribution rate sort of north of 20,
Yeah.
I think it's highly unlikely that the total return of that strategy will be north of 20 over the long run. And so I think one of the key pitfalls is, again, I'll bring this back to the insurance company example, thinking about an insurance company bringing in premiums and then paying out depending on these uncertain future events. So if you just viewed those premiums as income of that company, and that company paid those out as dividends to an investor, potentially there wouldn't be any money left to pay out claims, right? And
Mm,
so options tend to work the same way. And so I think one pitfall that investors can run into is viewing the premium alone from an option strategy or a covered call strategy as income. To me, what matters is how that options portfolio can do over time when you factor in both the premiums and the potentially capped upside in up markets, which is,
mm,
of course, negative value for the portfolio. Now, ultimately, I think like an insurance company that brings in more premiums than they pay out is profitable. You can do that with options, but I think one of the pitfalls is that people people, investors like tend to look at just the premiums alone as income without considering all these other factors. And so when investors use that to create a fund that has 20% plus yields, that fund's not necessarily or highly unlikely, when we're getting into the 20% plus, that fund's highly unlikely to be able to generate that over the long run, then you're risking or grinding that NAV lower as we discussed.
I see.
Now, sometimes also, if I could illustrate it too, I like to give, this isn't a covered call example, but I like to give sometimes like extreme scenarios as a way to illustrate my point. And so one way I like to characterize this is that, like, I could come up with a fund, call it like a dumb fund. Investors give me like $100 and I just put it in a checking account, right?
Hmm.
Checking account doesn't earn any return, but I pay out a distribution of 10%, so $10 per year, right? So you're getting paid $10 per year. That this hypothetical fund is not earning any return. After 10 years of paying out $10 per year, there'd be no money left, right? So your NAV would grind down from 100 down to zero.
Yeah,
You'd get your money back. And so that's why I think it's important to look at, again, the total return potential of a strategy, not just option premiums and how that translates into to income.
of course. Perfect. And I mean, w- what kinds of option income strategies, cover call ETFs, are shining right now with uncertainty in the markets that we have been seeing as well?
So I think we touched on this a little bit. I believe that just because of the environment we're in, we talked about the difference between the 2020s and the 2010s. Volatility is higher. The volatility is moving around a bit. I honestly do believe that having a strategy with active portfolio management on the option side, active management of the cover calls, I think that those will be the strategies that really do well over the next several years, assuming this type of market environment stays in place. And where we're on the call side where we're seeing some inflows as well. I'll take this a little bit away from the covered call side, is like a few areas of the market that we really like, where we've seen some inflows, where there are sort of key themes driving the market would be infrastructure, financials, and technology. These are all areas of the market that we really like. Infrastructure, of course, we've got aging infrastructure all over the world, the need to build new bridges and roads and power plants, right? And then, of course, you've got the artificial intelligence theme on top of that, building out, um, nuclear power and solar power, wind power, all different sources of power to help power these data centers that are going to drive our ability to use artificial intelligence projects. Of course, like banks go right along with that. They're the ones that help finance all that stuff. So we like banks. And then, of course, the tech sector speaks for itself in terms of like growth in the market. So we do like, covered call strategies with exposure to those key themes.
Yeah, I mean that's what you know what for myself, and I know many others that's why we're a big fan of these income strategies, is that it gives you that opportunity to diversify your return, whether it be on that, capital appreciation side, but also on the income side as well. Yeah, I mean, if you're in a period of time like we just discussed, right? COVID or post-COVID, if you're maybe someone who is just solely relying on share price appreciation, I mean, who knows what, I mean, no one knows what the market will do, what kind of return you might get, but at least with some active management, some call writing in there as well, at least you can generate some form of return, not knowing what the next 6 months, year, what the rest of the decade is going to do. I would say that we're probably not as confident as we were in market growth as maybe we were 10 years ago.
Right.
Yeah. So, what asset class are people flocking to the most right now that might be wondering if an income strategy exists for such an asset class? Why might this asset be seeing higher inflows from other asset classes, I guess. And I guess we can also speak in terms of the different vehicles. It doesn't necessarily have to be cover call related, but maybe just from, yeah, like I said, from one asset class to the other.
Yeah, so actually one area of the market, this is like, moving completely off of covered calls here, but one area of the market where we have seen some growth, particularly in the US, and now some funds have been launched in Canada to get exposure to this theme is CLOs. So these are they're called collateralized loan obligations. Is an income strategy. Essentially what it is, over the past decade or so, we've seen the rise of direct lending. So like institutional investors, alternative asset managers, you hear about like private credit. So there's like direct lending to companies outside of the banks. And a
Hmm.
CLO essentially will take those loans and break them up into sort of different risk buckets. So there'll be like a bucket where that incurs the first losses, and then ultimately at the top there'll be like a AAA bucket where it's like very low risk. Oftentimes, like those loans can suffer pretty significant losses, in a recession environment, and the AAA bucket would get paid. So we've seen pretty good growth of that and some number of fund launches in Canada. So it is, when I say AAA, it's like comparable risk to like a government bond, but it does tend to pay a higher income. So it's a way for investors to put their cash into something a little bit higher yielding that's very stable
Hmm.
and has very minimal risk of loss. So it's
Okay.
a little bit different than what you usually talk about, but it is something where we've seen some growth.
Yeah, and for the audience, if you're interested in CLOs, there is a book out there called The Income Factory by Steve Bavaria, and he talks his whole income strategy is around CLOs. So if people are wanting more of like an exposure to CLOs through a personal journey, that might be a book worth considering. And I've read through that as well. Can you also speak to because I'm curious about this as well. We don't see as many of these strategies. They exist, but put writing and when
Yeah.
it's kind of funny because throughout this conversation we've also talked about the fact that cover calls, cap upside. So naturally for the audience, if they think of put writing as the reverse, does it cap downside? I'll let you take it.
Yeah, so we don't do it's funny because our covered call funds like actually do have the ability to implement put writing strategies as well, but you're right, it's not very common. Oftentimes they're referred to as cash secured puts, right? So the way it works is you have cash. Um, you may want to put that cash to work eventually, so you sell a put option on a stock, which means that if that stock goes lower, whoever bought the put option from you is able to sell it to you at a fixed price. So it's essentially a way to, and then of course you earn a premium similar to writing a call. So it's a way to sort of earn income on your cash while you do have exposure to the stock as well. So if the stock goes down, it will get put to you,
Hmm.
and then you'll buy the stock. So oftentimes it can be a way to, if you have cash, you want to buy a stock, you're not sure if you want to buy it here, maybe you want to buy it a few percent lower, rather than waiting for it to decline, you can sell a put, say 3 to 5% out of the money, earn a premium. If the stock continues to tread water, you can continue to do that, earn premiums. But if it trades lower to the strike price, then it gets put to you. So it's kind of a way to like buy a stock lower.
I see.
Um, the risk of that, of course, is the market runs away. Say you try and do that on Nvidia starts trading higher and higher and higher. You can earn premiums, but then you never end up buying the stock,
I see.
right?
Yeah.
So,
Yeah.
it is, yeah, it's not as commonly used as covered calls, but it can be a good way to deploy cash if you're worried about near-term downside in the market or near-term downside in a stock, or oftentimes too, it's I find one pitfall that every investor runs into is you say, "Oh, I'm going to buy that when it's down 5%," and then when it declines 5%, you think, "Oh, it's going lower." So it's writing a put as a way to sort of lock yourself into buying it.
Right. Yeah, I see. So that I think again, a good explanation as to why the vehicle of cover call writing is more often used than a put writing strategy. Because at least with cover calls, you own the underlying, you capture the upside, whatever that upside might be,
Yeah.
pretend based on whatever the strategy is, and earn some premium along with it. So no, I like that explanation of the what's going on with put writing strategies. Well, Mike, I really appreciate you joining us and answering some of these questions. Now, if someone maybe wants to explore some of the Brompton products, or if possible, like reach out to Brompton, is there any way that they can do so on the website? Or is there maybe an email that they can reach out to?
Yeah, so I mean the best way is to peruse through our website. We've especially over the last 5 years, we've put all kinds of content on the website. So we have different, we call them Brompton Insights pieces, written content. We have webinars on there, different videos, that kind of thing, and all of our contact information on there as well. If you look at the contact page on our website, you'll be able to reach our investor relations line, and if you have any more questions, if investors have any more questions. But yeah, lots of content on there, lots of ways for investors not just to look at our funds, but we put out lots of content, lots of research pieces and things like that may be of interest to your viewers.
Yeah, perfect. And for those who are newer again to cover call ETFs, Brompton does have a lineup of cover call ETFs worth checking out over there. So until next time, Mike, take care.
Yeah, thank you for having me.